Hello, I'm Lelda Smits for the Finance News Network, and joining me from online broker and CFD provider CMC Markets is its Chief Market Strategist, Michael McCarthy. Michael, welcome to FNN.
It's great to be here.
Okay, Michael, now we're on the verge of reporting season. What are your expectations and what sectors and stocks will you be paying the most attention to?
Well, broadly, we're looking for system growth a little over 3%, and that should translate to profitable growth approaching 6%. And that would justify the market at current levels without really giving us a leg up. So we'll be looking not only for the individual stocks, but also for the implications for the broader market that come from particular sectors. A key issue for markets over the last 6 months has been weak consumer sentiment. And so the performance of the consumer discretionary area will be important. To get a grip on where growth is around Australia, I'll look to the consumer staple stocks. They're essentially food utilities. This is a basic measure of how the Australian economy is going overall, and growth in that sector generally reflects GDP growth and could be a good lead in. To get at an idea of where business sentiment and consumer sentiment are lying in respect to growth, I'll be looking at bank results. And although we won't see, the only major report we'll see will be CBA, it is a crucial report. They're exposed to every sector of the Australian economy, from consumers all the way through to the top corporates. So any growth in their loan books that's greater than 3% would be, or greater than the growth that we're seeing in, for example, consumer staples, would be a sign that optimism is on the increase. And of course, that has clear implications for share valuations.
Okay, and what are some surprises we could possibly see?
At the moment, the markets are factoring in lower prices for iron ore without compensating for the increased volumes that are driving that lower iron ore price. We saw in trade data from China recently that not only have volumes of iron ore exports or imports to China increased by 19% year on year, but the value of those imports has increased by 5%, and that's not what's being factored into models. And in the upcoming reporting season, I suspect that one of the greatest areas of surprise could be the iron ore producers themselves. Fortescue, BHP, Rio in particular have all been producing at record levels, and while prices have fallen, I believe the total effect on the bottom line will actually be an increase in revenues, not the decrease the market's expecting.
Now, Michael, you look at the markets daily. What's currently catching your attention? Could you give us an example of a great stock story?
One of the best stock stories, I believe, at the moment is Seek.com. It's not just that this is an IT stock with a great growth profile. IT stocks generally are leveraged to the economic cycle, and as recovery comes through, they benefit much more than other companies because the cost of producing another ad is very low. Most of their costs are fixed. And so when we see a pickup in activity, it's the IT stocks that are particularly leveraged. I like Seek anyway. I think it's well run. It's been very aggressive in its expansion. It's moving. It's becoming much more of an international stock these days. And with that leverage to a pickup in growth, not just in Australia but across the Asia Pacific region, I suspect it's going to be one of the outperformers.
Okay, and on the flip side, have you identified any stocks poised for downside or any trends we should be watching out for?
I'm particularly concerned about the healthcare sector. It's been a beneficiary of legislated earnings. That is, because the government pays most of the bills in the healthcare sector, investors have piled in, seeing it as a defensive approach through the risky times that the markets have travelled through. That's led to some lofty valuations, and while we have seen some corrections, I believe that there's still plenty of vulnerability on the downside for healthcare stocks.
And are there any stocks in particular to watch out for?
In particular, I'm concerned about Cochlear and ResMed. Cochlear has had some well-known problems with their products. However, competition is ramping up, and changes to legislation in the US could severely affect their overseas earnings. And ResMed's in a similar situation. Not only do we have currency issues for both of these companies because of their offshore earnings, but we also have concerns about those changes to the way Medicare and Medicaid in the US will treat ResMed's products. And if they do get an adverse ruling, the hit to earnings will be significant, and the share price is likely to reflect that.
So, Michael, which companies are looking cheap right now and perhaps showing some signs of value?
I like companies in transformation, and Oil Search is, for mine, a company in transformation. It's going from being an explorer to a producer. Now, they've proved up their process. The chief operator, Exxon Mobil in PNG, has done a great job. They brought gas on stream early in March this year. The market has increased Oil Search's valuation over the years, but I don't believe that at current levels it reflects the real potential for cash flow in this company, and I suspect that we'll see double-digit prices for Oil Search shares at some stage in the next 12 months.
In the first half, the ASX has seen a series of takeovers emerge. Where could we see some M&A action in the second half?
Well, it could happen anywhere. Looking globally, one of the areas which is surprisingly cheap relative to the rest of the world is consumer discretionary stocks, and in particular top-line retailers. We've already seen David Jones taken out by Woolworths of South Africa. I would be very surprised if other global retailers are not currently running their ruler over the Australian retail sector, and I suspect that Myer might be a candidate for an attempted takeover at some stage in the next 12 months.
Finally, Michael, you've been involved in FX, commodity, interest rate and equity markets for more than 30 years. What are some of the biggest mistakes that you see traders make?
For investors or traders, the route to superior returns is to cut losses and run profits. It's that simple. It's that simple to say. It's much harder to do. Investors particularly tend to hang on to stocks that are not performing for far too long. And so to improve returns, it's about efficient use of capital. And for individual investors, that means getting out of dead capital, getting out of stocks that are not performing and moving into the stocks that are performing. I also see the problem in reverse. When stocks start to perform, investors often jump out too early. Once a stock is moving in your favour, it's worth hanging on and perhaps giving up the last few percent once it turns rather than jumping out before the uptrend is completed.
Michael McCarthy, thank you for the outlook.
My pleasure. Thank you, Lel.